James. How are you today?
I'm doing great. How are you doing?
I am great. Thanks for being with us, guys who are watching live. If you're watching recorded, we appreciate you too. Today, we're going to do a deep dive into a couple of plans for business owners called solo 401k plans and cash balance plans. 2 weeks ago, James, Zach Langan and I did kind of an overview of most of the plan options, including IRA, Roth, simple plans, SEP, these kinds of plans. And we touched on cash balance plans and on solo 401ks, but we also knew we were going to do a deeper dive with you this week. I wanted to give you a chance to introduce yourself and tell them a little bit about your firm. I will just say before you do that I think one of the benefits that working with our firm brings to our clients is this network of people who specialize in certain areas can really have for them. I was talking with you earlier, and number one, I find a lot of just lack of understanding about even solo 401ks and cash balance out there among people who, are doing tax returns and things like that. But then even if they're aware of it, it's one thing to know about the plan, but it's quite another to really understand the ins and outs of it, because they're very customizable. And so that's where somebody like you, I think, can be incredibly beneficial in the discussion and implementation of these plans for the right situation. So tell us a little bit about yourself and your firm, and then we'll kind of unpack this.
Okay, my name's James Pinder. I'm a plan consultant for Nova 401k. I've been in the industry for about 20 years. Actually started off with a company called the 401k Company. So done a lot of primary work with large employers and small employers when it comes to retirement plan. As far as Nova, we are one of the largest third-party administrator of retirement plans in Texas and in the nation. We were started in 2000, and we work mostly with anywhere from owner-only plans to 2,000 employee plans.
Yeah.
So wide range of plans, but we have our own actuary team. We have 4 risk attorneys, so we're pretty well staffed as far as helping clients with their retirement needs. But my purpose today is kind of go over the solo K and cash balance, and maybe I can help give you some ideas for bettering your retirement plans.
Yeah, thanks. And I think you guys are getting close to 10,000 of these plans you've set up and operate.
It's nine billion in assets, but we have about 7,500 plans.
Okay, I was thinking y'all were over 9,000. Anyway, 7,500 is a lot of plans. That's a lot of at-bats, as I would say. And some of those plans I know are, like you said, 2,000 employee 401k plans. But today we're not talking about that. We're talking about the much more common smaller business owner, right. And they might have 10 employees, they might have 20, but most of the time we run across folks who it might just be a husband and wife, or it might be a team of 5 or 6 people, maybe a professional company with some employees. And there are some very powerful planning possibilities using these tools, but you got to understand what they are. And then when they fit, you really need somebody who is going to not fumble the ball where you get unhappy letters from the IRS. So that's why we like working with companies like you guys. We know that when you get involved, it's going to be done right. So anything else you want to say before we dive into, I guess we're going to start off first talking about solo K plans and kind of explaining what those are. Anything else you want to bring up at this point?
Sure. Just kind of let everybody know what a TPA is. So a third-party administrator for retirement plans, we're basically the CPAs for 401k plans. Mm-hmm. We do the compliance. We make sure the plan is in the rules of the DOL and the IRS. We also calculate the numbers for you to be able to tell you how much you can put away. And we will also give you advice and help you with plan design. Pretty simple. We are, I like to say we're like the nerds of the 401k world. We do all the fun stuff.
That is a really great point, because there's a lot of confusion when we're talking with people about these plans. And sometimes they'll be talking to you and they'll say, so what are you going to invest me in? and your answer is, I have no idea. That's not our role. Our role is to make sure the documents are done right, make sure the filings are done right, all of those things. And that's a good way to put it. You're the CPA of financial plans. I mean, of retirement planning for them, because you're handling all the paperwork, all the filings, and all of that stuff. Hopefully, we are involved on the investing of the money, and that's kind of our role. But enough about that. Let's kind of get into talking about what a solo K is. We call it a solo K. It's often referred to as a solo 401k plan. Would you like me to go ahead and share your visual now, or do you want to just kind of unpack it first?
Well, you can start sharing it, but I'll go over what a solo K. Also, sometimes you'll hear them referred to as owner-only Ks.
Uh-huh.
So an owner-only K or solo K is where you have a person who is either self-employed or has a business where only them or their spouse are the only two employees.
Mm-hmm.
So in an owner-only or solo K, you would not have more than one. You would only have the one employee, which is the owner, and maybe their spouse.
Right.
And the rules of that basically are you are able to put money in as the employee, which if you look on this chart here, if you're under 50, you can put in 19,500.
Mm-hmm.
If you're over 50, you can put in 26,000. As a owner only 401k, this amount is you're putting in as the employee. It can be either pre-tax or Roth. So if you're someone who wants to do a Roth and you make too much money to put into a Roth IRA, an owner only 401k plan or solo K allows you to put up to $26,000 in Roth. If you're over 50 and 19,500. The other part of the solo K is you have what's called the employer contribution. So in an owner only K or solo K, you're wearing both hats.
Mm-hmm.
You're wearing the hat as the employee and the hat as the employer.
Mm-hmm.
You're able to put up to 25% towards profit sharing, or profit sharing is the general rule, but think of it as just an employer contribution made to your retirement plan.
Mm-hmm.
So in this case, with the combined contribution of your 401k contribution and your profit sharing, you're able to do 64,500.
Mm-hmm.
If you're under 50, you can do up to 58,000 a year.
So let me just camp on that for a second with you, and get you to clarify something. Let's just imagine hypothetically we've got a solo employee owner, professional company, let's say, and they set up a solo K, and they want to max the contribution out at that 64.5. Let's say it's somebody over 50, right? So in order to be able to put the 64.5 in, we know they could put the 26,000 in, right? Just for their own contribution. But then the difference is about, close to another 40,000. Would they have to have earnings of, would it have to come out as salary and it's 25% of salary, or let's say it was a sole proprietor and it's just net profit, or it's an LLC net profit? It kind of explain that for us. How would we get to that 64.5 in that example?
That's actually one of the best questions to ask before you set up a plan, because when we're looking at salary and percentage of compensation, mm-hmm. we're only looking at that like Schedule C or W-2, depending on how you pay yourself. Mm-hmm. It cannot be based off profits mm-hmm. or any kind of deduction. It has to be based off your earned income within the company.
Okay. And so if it's a sole proprietor, then all of that income is going to be considered, the profit will be considered earned income. So it'd be 25% of that number, right?
Correct. Usually it's when you're looking at your tax form, you'll see like Schedule C.
Mm-hmm. Right. Okay. So in that case, they would only have to be making about 160,000 of profit to be able to do the maximum 64.5.
Correct. 160,000 income.
Right. Of income. And then if they had a really healthy cash flow, and let's say they're married, then they got another opportunity. What would that be?
So if you're married and you want to hire your spouse as an employee, you can actually contribute to the 401k based off their earnings as well and their age. So you can do up to about 90% in a 401k plan, mm-hmm. make it where it works with taxes. So if you could do at least 26,000 if they're over 50,
yeah,
off an income of 30,000. So it's a
Right.
good way to put more money away. And then the profit sharing would be 25% of whatever you wanted to pay them as wages.
Hmm.
But yeah, that's the only time it works. If you had two owners that are not spouses, you couldn't do owner only play. You can only do that if it's a spouse.
Got it. Yeah. So just to kind of bring that together, if you had that original scenario where, let's say somebody's earning 160 and they don't really need that 160 to live on. So they want to put as much as they can pre-tax, but they want it to be flexible, right? They don't want to have to make the contributions every year. Then this might be a good option for them. And if they could hire their spouse and pay them 30,000 as a bookkeeper or whatever, a lot of times the spouse is already doing that. They're just not drawing a salary for it, right? So if you add the numbers up, then if they're making 160 of earnings, and they take 30 and they pay it to the spouse, now you're talking roughly 64,000 for the owner slash employee plus 26 for the spouse. You're looking at maybe 85,000 bucks pre-tax, or it could be going into Roth plans, right?
Correct. Yeah.
That's amazing. I don't think many people understand that you can do that, and there are a lot of companies out there that have the cash flow to be able to take advantage of it. They just don't know about it.
Yeah. And it's something that when I share with people, they're usually pretty shocked about how much they can put away.
Yeah, what we see most of the time, and I don't fault CPAs at all for this, because their world is just crazy, especially when tax time comes. But you know where I'm going with this, right? We see people come in and they've got an SEP plan, and that's good. And they don't really have any good reason for it other than we set that up one year when we were filing our taxes, and the CPA said, well, if you can save some tax if you'll open an SEP. Well, you could still do that because the SEP allowed you to open it up, till your same tax filing deadline for the prior year. But you couldn't do these plans like that. You had to have them set up in advance. So having this kind of solution available is one of the real advantages to being proactive rather than just always operating reactively, right?
Right.
Because in that same scenario, an SEP best scenario is 25% of 160,000. That'd be the most they could put in.
Correct. And a lot of times what I'll see is someone who has 100,000 of active income with 200,000 passive. Well, in a SEP IRA, they're really just limited to 25,000 because it's off the active income of 100,000. Where
Gotcha.
in a solo K, they can do the 26,000 plus 25%. So they can do 51,000 versus just 25,000.
All right, so that gives people a pretty good understanding of the solo K, where it can be powerful. But every now and then you have a situation where maybe the owner is really got some healthy cash flow. Maybe they've signed some deals and they're going to have a spike in revenue, and they just know they're going to get creamed on taxes. Plus, they're a little behind on their retirement savings, and so they're thinking, yeah, well, 85,000 would be great, but I'd really like to save 200,000, 300,000, 400,000 if I could, and save a lot of taxes and also catch up on my retirement. So then we get into our next topic, and it's a little more complicated, a little less flexible. But talk to us about a cash balance plan and kind of unpack that for us and how that can work along with or separately from the solo K.
Okay. Well, just kind of give you a general idea. A cash balance plan is sometimes referred to as like a hybrid plan. If anyone remembers the old defined benefit plans, the pension plans, where the employers are guaranteeing a certain amount of income during retirement per month, the cash balance plan has a portion of it is based on defined benefit, where there's a certain guarantee by the employer, but instead of it being an income for life kind of scenario, it's more of a certain balance at the end of the plan. So if you do this much and work this long and make this much, you're going to have this much value in your cash balance plan. So it feels more like a 401k because the participants are able to see their cash value, where when a pension plan is just showing you how much you can get per month. This is actually showing you a balance. The difference is from a 401k plan is the investments are going to be much more conservative. So in a cash balance plan, this is not looking to be 25% growth. It's more of a tax play. So the IRS wants that growth to be more around 4 to 6% steady.
Mm-hmm.
And if you have multiple employees, it's usually an employer driven investment plan. So it's not something that the employees are individually picking stocks. The employer has it under a certain plan to draw about 4 to 6%. So sometimes I'll get that question like, hey, why can't I put this all in the S&P 500? Because really this is not a investment play as much as it is a tax play to try to reduce taxable compensation.
Right. And when we've seen these kinds of plans, that thinking is very much part of our thinking on recommendations for how portfolios are going to be built. We look at it all as one pie, right? It's all financial assets, and so your more conservative holdings would be in the cash balance plan, whereas your more growth oriented things might be over in the solo K plan when they're combined, or it might be in other investment accounts that are out there that aren't even part of the retirement plans. So what's the upside? I mean, what's possible with these for, let's say you've got a professional, self-employed professional who is really just, has a really healthy cash flow. Maybe they're making $500,000, $1 million a year consistently. They're pushing upper 60s, and they're married, they're just looking to put away as much as possible. What are the limits here? What are the upside limits theoretically?
Well, state the limit is usually about 230,000 a year, but as you can see with the illustration you're showing, that's usually like 230,000 a year over like a certain period. Mm-hmm. If you're older than 60, actually, we can kind of play with the numbers to put a little bit more in there, because with the cash balance, you have what's called an actuary mm-hmm. that plugs in the numbers, and they're using it based off your age, time frame, and they're also looking at return. And each year they will kind of figure out how much you're going to need to put into the plan. Mm-hmm. In this case, like someone between 60 and 65 could put a total of about 282,000
right
in the cash balance plan.
Mm-hmm.
And the reason is because they have a lot less time than, say, someone who's 55 to 59. Mm-hmm. So the number increases. This also is dependent on how much you make, but age is probably the biggest factor, because if you look, someone who's in their 30s, this is probably not the best solution for them, right, unless they really want a cash balance plan. Mm-hmm. But so I normally look at that magical age around getting in the 40s, where you start to build up steam on how much you can put away. Mm-hmm. The thing to remember is this is not something where you have one good year and you start a cash balance plan. This is something where you have a consistent cash flow, because the IRS likes to see these things that last at least 3 years. What they don't want is someone having a good year, setting up a cash balance plan, and closing it the next year.
Yeah, that can raise red flags. That's something that always has to be emphasized. So going back to our visual here, this example says a single owner company like this is assuming that they do a solo K and a cash balance plan together. That's where we're getting to 346,000. And it theoretically could save a chunk of tax here. If you're making the kind of money that you need to be making cash flow wise to justify a $280,000 contribution, you're probably in a pretty high tax bracket. But then you could also, going back to that spouse thing, if you have a spouse, you could hire him or her, and then they have another 26,000 at least that could go into the pot. So you could be pushing 400,000 all pre-tax, or largely going into a Roth account. I guess you can't do the cash balance into a Roth. It would only be the solo K, right?
Correct. Only the 401k contribution on the left-hand side there could be Roth.
Got it.
Everything else, profit sharing, cash balance, would be considered pre-tax. The cash balance is also seen as a business expense. So what I will see a lot of times, let's say someone having income of $500,000 as active income, they'll reduce their active income by the cash balance. And so you can reduce your active income and use the cash balance as a business expense.
Okay. As a planner, that raises other questions for me. We're always looking at multiple layers on this stuff, right? And so if somebody is concerned about their taxable income when it comes for getting credit and loan approvals or something like that, they need to at least be aware of that up front, that it is a business deduction, right? So that's going to lower their personal tax return. And so there's all of these pieces work together. So it is important to be very thoughtful and not just go out and make a tax decision. But generally speaking, we see two huge motivators that would drive this if people want to do a cash balance plan, particularly combining it with a solo K. They, like you said, they've got very healthy cash flow, and they want to maximize or minimize the taxes they're having to pay because they're sick of paying, a third of their money out in tax. And oftentimes, I'm sure you're aware, we see it all the time. A lot of times business owners have a really big net worth on paper, but they don't have liquidity. And so this can be a way to really change that in a fairly compact period of years, right? If you're putting in $400,000 a year into these combined plans and you do that for 5 years, that's $2 million of liquidity that you've not had to pay tax on yet. And that can be part of the thoughts that will go in when we're looking at business exit planning, for example. A lot of times people think, if I don't sell my business, I'm never going to be able to get, have a liquidity event. Well, yeah, you can. You can just do it over a period of years, and you just got to be smart about how you approach it. So
I think you just hit I think you hit the main point there for a cash balance plan is a good way to take out money out of your company and do a tax deferral.
Yeah.
Into a retirement. That's one of the main reasons somebody would do a cash balance plan.
Well, yeah. Imagine you're an owner and you're thinking, I could probably sell this business for $2 million, but there might be a lot of unknowns and risks associated with that and everything. And then you think, well, wait a minute, I can pull $2 million out of this into my retirement plans if I just set up these kinds of plans. And 5 years from now, I've still got the $2 million, and heck, maybe I'll just close my shop and walk away, or maybe I'll still sell it, but only have to sell it for $1 million or whatever. There's a lot of ways you can look at these tools. They are just tools to try to get to where you want to be. But this is a big, big tool in the right circumstances. Now, another thing I was talking with you about earlier, for a number of years, I kind of thought about this mainly when it was a husband and a wife, or a wife and a husband, and there wasn't a lot of employees involved, because I thought, this would be too expensive if you got employees downstream. But as you and I have gotten to know each other, I've learned that that's not actually the case. These plans are very, very flexible in how they're designed, working with a group like yours. And we have another example we're going to look at. I'll let you kind of say what you want to say about that. But you seeing this okay?
Yeah, I have that.
So, kind of bounce off of that. What are your thoughts about that?
So, yes, that's another thing I will see where you might have an owner and a spouse who have a company with a few employees. Mm-hmm. And they're really and they have a really high cash flow where they're trying to reduce their taxable liability without costing a lot of money. Now, you were talking about SEPs earlier. Well, in a SEP, if you gave yourself 25% towards your SEP, you have to give all your employees 25%. Mm-hmm. So what a 401k and a cash balance, basically you can add what's called a 401k profit sharing with a cash balance plan. And it allows the owner to put a lot of money away with kind of reducing their costs. They're not having to follow the rules where what they give themselves, they have to give the employees. Mm-hmm. Now, I will tell you this works when the employer average age, the owner and the owner and spouse in this case, is older than the employees.
Yeah.
For instance, if I had
in this example, you've got an owner and spouse that are in their 60s. But what really stood out to me was employee number one here is shown to be 70 years old, and yet the hypothetical contribution's only 1,000, and I'm not sure how the actuaries pull that off, but
Sure.
anyway, that was
So I'll kind of explain how the actuaries pull this off. And they look at the average age here. So if you look at, you have a 31, 41, 46-year-old.
right.
So they're actually averaging that out with the two owners who average about 65 and a half. But also, so you have 3 buckets here. Actually, and I'll go 4 buckets here. So on the hypothetical cash balance, that is the cash balance portion being put away for the owner and the spouse.
Right.
The $1,000 is sort of like a minimum credit that we need to give each employee for the cash balance. The reason they're able to get away with this is because we're balancing it out with a profit sharing contribution. So on the next row, you have the 401k deferral, which is all the employee driven. The employee safe harbor plan is 3% of compensation. And
so that's a matching contribution made, but it's mandatory when it's a safe harbor. That's made by the employer for the employees.
Yeah, it's called a non-elective. And there, you can have a safe harbor match, but on a cash balance profit sharing combo, you do not want it because the match doesn't go against what you have to give the employees. So the DOL has these rules set up that the plans cannot solely benefit the employer. It has to be for the sole benefit of the employees. The reason the cash balance works this way is because we're able to take the average age of the owners and kind of discriminate against the other employees because they have less time to hit retirement.
Got it.
And you basically have group A ownership and group B non-ownership. In this case, the ownership is getting paying the owners most of the cash balance, and they're balancing out, the actuaries here balance it out using that employer safe harbor with profit sharing. So even though the employees are only getting $1,000, they're receiving that safe harbor and profit sharing where the owners do not receive that.
Right. And that's these two, the safe harbor and the profit sharing. And so if you look at the result over here in this example, you've got 290 and 4,500 going to the husband and wife, or wife and husband. And then you've got, these amounts for here. So if you look at the bottom line of all the money that's contributed, 95% of it is going to the owner and the spouse. And that is such a powerful difference in, if they were just doing, like you said, an SEP plan, it would be 25% of payroll for everybody, right? Pro rata.
Yeah, the owners would get to put away a lot less.
Yeah.
And the employee costs would actually be higher than it is with this combo plan.
Well, I told you before we got started today that 30 minutes would fly fast, and we've got a couple of minutes left, James. So, let's kind of bring this to a close for today. Obviously there's infinite numbers of combinations of how these things can work, but help us understand when we bring you into a discussion like this, what do you do to help educate and kind of execute these plans for people? Help people understand how that works. If they say, yeah, I'm really interested in figuring this out, explain what you guys do from there to actually getting the plan open and getting it rolling.
Sure. So the most successful way to get a plan started is like creating the expectations. So normally when we're looking at this, we will get information from you about either you and, if it's just you and your spouse, we'll get your ages, compensation, date of birth, and when you were hired or when you started the company. If you have employees, we'll have a census profile we'll send you to get an idea of what your employees look like. Once I get that back, one of the questions I'm probably going to need to know is, how much money were you looking to put away? We showed you the maximums, but that's not what you're not required to do that. If you want to go less and do, let's say, I want to put an extra $100,000 away in a cash balance plan, you're more than welcome to do that. What Bob and I are showing you these are some maximum numbers.
Right.
And then once you give me that information, I turn that over to our actuaries. They will go ahead and formulate a plan that's going to be most beneficial to you while reducing your employee costs. And they'll give you assumed rate of return, which will probably be about 4 to 6%. And from there, we'll talk about different plan designs, but from there you can say, yes, I like that. Or if you want us to make some changes, we can do that for you as well.
Well, James, again, thank you so much for being with me today. And I look forward to actually helping clients with this, working with you more in the future. I'll just quickly say that next month we're shifting gears. This month we've been talking about retirement plans for self-employed folks, and next month we're going to focus on college education and how to pay for that. In 2 weeks we'll be looking at financial aid, and then a couple of weeks later we'll be taking a look. Zach and Sydney actually going to break down 529 plans. But for today, if you guys have any questions about this, if you think that it's something that you want to really dig into, you know the drill. Just raise your hand and let us know. We can connect you directly with James. We can also share information with you, whatever. But at the end of the day, it's all about collaborating the professionals that you work with, or maybe folks you need to be introduced to, like James, and customizing a solution that works for you and your circumstances. And you guys who know us, that's how we approach everything around here. So I hope this was interesting for our watchers and viewers today. James, I hope you have a wonderful day. Thanks again. We'll go ahead and wrap it up. See you later.
Thanks.
Bye-bye.